Fed, as we know, has interest rates at elevated levels. I don't think they should raise rates tomorrow, but neither do I think that is the end of the tightening cycle, because inflation is still running at quite elevated levels.
It is too soon to expect that the Fed will throw in the towel, so to speak, on their inflation fighting.
Everything is so interrelated. If the Fed is hawkish, then that's going to mean higher real yields. It probably means wider credit spreads. It probably means a stronger dollar.
I think they'd be well advised to pause here. You don't want to play around with banking crises.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It is 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Fed's caught between inflation and a sudden banking crisis. We will learn today whether policymakers choose to keep raising interest rates or put the hikes on hold. More fallout from the Credit Suisse takeover. The Swiss government freezes bankers' deferred bonuses. Meanwhile, UBS offers to buy back billions in bonds it sold just before the deal. And Nike posts sales that beat expectations, but profit at the athletic wear giant comes up short. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Anna Edwards and Matt Miller, as you may have noticed, are off. Kriti, we've heard from the ECB. Madame Lagarde speaking now. The BOE, arguably, it's a clearer picture from them, given red-hot inflation that comes through from the UK. The Fed, though, it is uncertain.
A lot to digest for sure. When you look at the markets here, though, it's an interesting day because, of course, to your point, the Fed is going to be in the spotlight today. It's finally Fed day, which, of course, in theory, should mean a little bit of risk-off sentiment. Tom, this has been the trade going back over a year. The idea that futures have been down, stocks have been down in the lead up to the Federal Reserve. This time just a little bit different, given that we had that rally yesterday. But nevertheless, futures taking a little bit of a breather today, but I wouldn't call it major conviction in either direction. Down about 0.2% on the benchmark. I want to take a look at the bond market, though, because it's all about the pricing. 25 or pause seems to be the two options on the table, but don't rule out, say, a 50 or 25 basis point cut, as Nomura and Citi once said. We'll see if those calls stick throughout the rest of the day. Of course, the two-year yield at 4.12 here. We're looking at a 3 basis point move lower. Look, if you're looking at a terminal rate of 4.75, hypothetically, as a pause, there is still a major dislocation in the front end of the curve. So that's going to be an interesting trade to kind of watch to see where the Federal Reserve goes next. If there is that 25 basis point hike, you're going to feel it in the Treasury market. The folks that are shorting Treasuries perhaps benefiting from that trade. Go out further on the curve. You're looking at a 10-year yield of 3.58. Meanwhile, a crude kind of trading with a 69 handle. I'd argue post-Fed, Tom, crude is going to be the story, down about 0.7%. What's going on in Europe?
All right, that's an interesting call. We'll keep across the commodities picture, of course. It's a muted picture here in Europe. The DAX over in Germany just holding on to gains of a little over 0.1%, given the rally that we saw yesterday. Over in France, the CAC 40 is off by 0.1%. And in Spain, the IBEX just clinging on to some very meagre gains. A bit of a holding position in the equities markets. The UK under a bit more pressure, down 0.2%. But the focus and the interest is really in FX, and particularly in the bond markets as well, of the gilts, given the inflation print that's come out in the last couple of hours out of the UK. Let's switch it on, see how things are moving then cross-asset. I want to zero in, of course, on what's happening at gilts then. The 2-year, 347. Look at that move higher. 19 basis points as investors readjust to an inflation print that came in at 10.4%, well above the forecasts of 9.9%, and just baking in expectations that the BOE, which is up on Thursday, will have to move at least 25 basis points. Again, across the benchmark European stocks, just a gain of 0.1%. Banks are back, though. The solid gains that we saw yesterday, gaining almost 5%, the sector yesterday, posting additional gains today of 0.7% so far in the session. A little bit of stability, then, around that sector, at least for now. Here's the pound, 122, gaining 0.5%, a rally for sterling, again tying in to that CPI picture. We mentioned Madame Lagarde. The euro is also stronger, reiterating the need to continue fighting inflation. Kriti.
Yeah, certainly something we're going to be keeping an eye on. Happening right now, though, to your point, Christine Lagarde speaking at the annual ECB and its Watchers event. Let's actually dive in and hear what she has to say.
And business investment also contracted at the end of last year. The greater role played today by sectors that rely on discounted future earnings, such as tech, could also make monetary transmission more powerful. What we will have to monitor carefully in the weeks and months to come is whether there is a further strengthening.
Okay, that is Madame
of
Lagarde
this
there
path.
speaking at the ECB Watchers event in Frankfurt. We'll continue to keep across the lines coming out from the president of the ECB. Let's bring in our chief European economist, though, Jamie Rush, for the analysis of this and a call, of course, on the BOE. But we'll start with the ECB. Listening in there, she's very insistent that inflation dynamics have yet to show any signs of properly and significantly abating in the Eurozone. They are determined to get back to that 2% target and saying, again, there is no conflict, there's no contradiction between price stability and financial stability. Your take on what we've been hearing from the ECB's Lagarde?
Well, I think on that latter point, there are now two ways you can be hawkish as a central banker. You can be worried about inflation, or you can be hawkish about the separation of financial stability and monetary policy. And I think that's what we've seen at the ECB. People who are considered doves on inflation are also, they can be still hawkish about that separation. They're not in favour of pragmatism about the rates path. They want to separate those things completely. So I think that's one lesson from the ECB's latest meeting. Lagarde, what we're hearing is this shift in the reaction function a bit. So previously, they're just focused on underlying inflation. That seems to be the major driver, basically operating policy in the rearview mirror. Now she's placing a bit more emphasis back on the inflation forecasts, and they're thinking, of course, about the transmission of policy and how that's going to affect the economy. So she set out three things, and because they haven't got any guidance, so they have to set out a reaction function. Yeah,
she talked about the fact energy prices have come off, but then she also touched on wages and the throughput and how long this is going to take. Services, of course, and inflation there remains sticky. There's a deep concern that they haven't really addressed this. Where does it leave your assessment and the team's assessment of where rates go from the ECB in the months and quarters ahead?
So our view, so before the banking crisis began, our view was that they would take rates to 4%. From what we can see about the tightening of financial conditions since, you maybe get to a terminal rate of 3.75, maybe 3.5. We're not at the stage yet where we can say the banking crisis is going to take all further rate hikes off the table. So we don't think they're going to pause. We think they will do 25 basis points for the next few meetings. Condition, of course, on things not blowing up further.
OK, that's the call from Jamie Rush and the team at Bloomberg Economics. Thank you very much indeed, as Madame Lagarde gets to the end, it seems, of her speech there in Frankfurt. Now, UBS is offering to buy back about 2.75 billion euros worth of bonds it issued just days before agreeing to acquire troubled rival Credit Suisse. For more, we're joined by Bloomberg's senior finance editor, Stephanie Bianchi. Stephanie, can you talk us through the thinking then behind this move from UBS?
Sure. And as you say, it's about $3 billion of bonds that will be offered from today. And these are bonds that were offered just days before this now, I guess, infamous deal by UBS for Credit Suisse. And it's really giving those investors to reassess what they bought into before this deal happened. So perhaps have a second thought about the risk that is now involved with these bonds. So it really will be interesting to see what appetite there is for this buyback.
Stefania, we're hearing that there may be further American government involvement to shore up the banking sector across the Atlantic. What kind of involvement might that look like?
That's right. It's from one troubled bank to another. So what we're hearing is that Wall Street leaders and US government officials have been in talks to see what sweetener they can offer to any potential suitors that may come along for this bank, for First Republic. We know as well that Janet Yellen said earlier on Tuesday that the government will take extraordinary measures if that's needed to shore up this bank. So really what they're looking to do is perhaps stave off any further bank collapses and any further disruption to the financial sector as a whole.
Well, certainly something we're going to be keeping our eye on. Stefania Bianchi, all over that story on the banks. We thank you, as always. I want us to go to some earnings news here. Nike posting quarterly sales that beat expectations as the sportswear brand worked down its excess inventory. But profitability came up short amid markdowns and high freight costs, add-on material costs. And it's not a pretty picture. Bloomberg's Joe Easton joins us now. Joe, walk us through the earnings. For me, I feel like I could put Nike in the category of American global bellwether alongside the likes of, say, Starbucks or Caterpillar.
That's right, Chrissy. Well, I mean, it's an absolute powerhouse, isn't it, in terms of its position in the market. But for me, the earnings were pretty strong, really. I mean, the revenue was up almost 15%, around $12 billion in terms of the quarter. There's not many companies in the space that can do that. The shares, though, did obviously slip after the market hours in New York and a little bit this morning. But really, that's because this stock is kind of priced to perfection. It trades at about 35 times the earnings. So it's one of the most expensive stocks on the street in that space. So I don't think the decline after market is really reflecting the strength in the earnings. Yes, the margins were weak, but that's mainly because of input inflation, wages, energy, things that are affecting so many companies. To me, I think the top line indeed is particularly strong for Nike.
Joe, where's the growth coming from in the months and quarters ahead? Are we looking at China? I mean, they face a lot of competition from some of the homegrown brands. I'm thinking Anta and others. Is that an opportunity still for them?
I think it is a big opportunity because that was potentially a weakness in the report from last night. China didn't come back as quickly as expected, so there is potentially some upside in that growth to come. And China is also their most profitable region simply because they make a lot of their products there, so it costs them a lot less to get it to consumers. So China is the big growth spot. The other growth is direct to consumer, which they're trying to do more. They're trying to rely less on companies like Foot Locker and JD Sports and sell stuff via their own website, via their own shops like Nike Town that we have here in Oxford Street. Although it gets quite busy down there, I tend to avoid it myself. But I think that the direct-to-consumer business is potentially where they could also see some growth as well as the China space.
All right, Joe Easton there with a take on the profits and the earnings coming through for the Nike, the opportunities maybe in China, and some shopping tips as well if you ever visit Oxford Street. Thank you, Joe. Right, happening right now, Christine Lagarde is speaking at the annual ECB and its Watchers event. She says the European Central Bank will take a, quote, robust approach that allows it to respond to inflation risks as needed, but also aid financial markets if threats emerge. We will continue to monitor for headlines, and you can, of course, watch it on Live Go. It seems she has wrapped up the speech. We'll get more analysis of that, of course, throughout the next few hours. Also happening right now, Francine Lacqua and Bloomberg's editor-in-chief, John Micklethwaite, are giving opening remarks at the Bloomberg Invest Summit in London. And later this hour, we're going to bring you Danny Berger's interview with Man Group CEO Luke Ellis. That is live from the summit. And tonight, we bring you David Rubenstein's interview with Citi CEO Jane Fraser. That's going to be a fascinating conversation, 8 p.m. New York time. This is Bloomberg.
I think it is too soon to expect that the Fed will throw in the towel, so to speak, on their inflation fighting. I think also not a complete pause may not only be counterproductive from the vantage point of the medium-term inflation objectives, but also could send the signal that they know something worse that the markets are yet to learn.
Carmen Reinhart there speaking, the former chief economist over at the World Bank, speaking with Bloomberg Television yesterday. Now, the Fed is really why we're all here at work today, caught between inflation and a sudden banking crisis. We're going to learn how Fed Chair Jerome Powell and his colleagues respond later today. Let's bring in markets reporter Valerie Teitel for a preview of the Fed decision. Valerie, I know we said between inflation and a banking crisis, but it feels like it's a story of inflation and a hard place. What is the Fed potentially going to do? What are the options here?
Look, Critty, I think it's very likely the Fed the Fed meets up with market pricing today and hikes 25. It has only taken 4 sessions to gone from nearly pricing in a pause to now pricing in 25 basis points. The Fed does not like to surprise, so they're very likely to hit this kind of market pricing. But the bigger question is, what are those dots going to show about the path forward? Will they revise them higher in a bid to try to show some confidence that the banking sector, the banking turmoil is contained? Or will they perhaps keep them where they are and say that the lagged effects of monetary policy are upon us and it warrants a change in direction from here? We have heard some similar things like that from analysts across the street. Let me talk you through a few of them. JP Morgan's Mike Feroli saying that the slower loan growth coming from these regional banks could shave a 0.5 to 1 percentage point off GDP. Mike Wilson saying that the risk of a credit crunch much has increased materially. And then Apollo mentioning that the recent financial tightening equates to 150 basis points of a Fed hike. It's going to be all down to the Fed's own assessment of this banking turmoil and its impact on lending conditions that the market's going to hang on to every word.
Valerie, when it comes to the BOE, the signalling prior to today had been that maybe, just maybe, they would pause tomorrow. And then we had another scorching CPI print. What are the expectations around the Bank of England?
A scorching print, Tom. It was the largest beat when it comes to inflation since 2009. 2009, the largest beat. It shocked many of us across the market. And now you have to think about what the UK is facing at the moment. The labor market is still hot. Fiscal policy was eased in the recent budget, and economic activity is still showing strong. This has led the market to price very quickly, going from a pause to a hike at tomorrow's next meeting. The gilt curve really took a pummeling. Geez, 2-year yields rising almost 20 basis points so far this session. This curve is bear flattening, and cable is strengthening along with it. It looks like a hike is on the cards for us tomorrow.
Yeah, the volatility in the global debt market is really historic, I have to say. Bloomberg's Valerie Teitel, we thank you as always. And of course, don't miss our special coverage of the Fed decision. That's starting at 1:30 p.m. New York time, 5:30 p.m. in London. Plus, of course, a slew of great guests throughout the day. Happening right now, though, Francine Lacqua and Bloomberg's editor-in-chief, John Micklethwaite, giving their opening remarks over at the Bloomberg Invest Summit in London. So be sure to tune in there. And shortly, we'll bring you Danny Berger's interview with Man Group CEO Luke Ellis live from the summit. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York alongside Tom McKenzie in London. Let's keep you up to date now with news from around the world. Here's the first word. Xi Jinping used his visit to Moscow to firmly align with Russia against the United States. Still, the Chinese president didn't give Vladimir Putin something else he wanted, a commitment to buy a lot more natural gas. That shows that China may be hesitant about appearing too close to Russia. It was Xi's first trip to Russia since Putin invaded Ukraine. It's a move that's certain to anger North Korea, the U.S. and South Korea, planning to hold their largest ever live fire drills in June. The exercise will involve mobilizing high-tech military equipment. The U.S. and South Korea are winding down training drills this week. North Korea has responded by threatening to turn the Pacific Ocean into a firing range. The CEO of TikTok will tell Congress that China has no authority over the data his app obtains. Shou Chew will also argue that TikTok does more to protect young users than rival social media. That's according to prepared comments reviewed by Bloomberg News. Chew testifies before a House committee Thursday. There are calls for TikTok to be banned in the United States. Tom, a lot to digest on the TikTok front, a lot to digest in these markets. It feels like the news flow certainly isn't stopping when it comes to the financial world.
Yeah, and we have a fantastic event that's taking place here at the Bloomberg headquarters in Europe, in London, of course. Let's cross over now to Danny Berger, our fellow anchor, who's in conversation with Man Group CEO Luke Ellis. She started by asking him, is the crisis over? Listen in.
Just to remind everybody, so it was up 30% yesterday. Yay. But that means that it was, as opposed to being down 90%, it's now down 87%. Right? I mean, 30% when you're down 90% is really nothing.
Is that where the risk is when you say that some banks might not exist? Is that where you're looking toward these more American regional banks? Or is it another Credit Suisse type bank that, at least at one point, was one of the most systematically important?
So it definitely applies to smaller, so whether it's regional banks in the US, it's challenger banks in the UK, it's, you know, in the end, what this has all reminded us is in the modern world where everybody's got a phone in their pocket, and if they want to move all their money from A to B, you can do it while listening to me, and you probably won't even miss anything I say in the time it takes you to move all your money from bank A to bank B. What that means is that at any time of stress, people are going to move their money to one of the banks that they think the government is behind. And that means the deposit base of any of the smaller banks becomes flighty. And the moment you've got, banking doesn't work if you haven't got a stable deposit base, as we've just seen. And they are naturally less stable now.
I think this is a really interesting point because not even just with mobile banking, but technology also allows us to tweet any concern we have about the bank. For VC founders to tweet saying they're advising all their companies to pull out money from a bank. Does this show us what crises will look like from now on, given the technology-enabled nature of them?
So yes, things happen at a much faster speed. Whether that's a crisis or it's good news that like information travels much faster. And so, yeah, you know, look, we had a run on a bank with no newspaper headlines because it happened before the newspapers had even got there, with no queues around the bank. You know, that's how the modern world works, and it throws certain parts of the banking system into question, and therefore regulation's got to respond to it, and it sort of means the big, highly regulated banks, where they are too big to fail, become the place everybody's going to have an account open that they can move their cash to at the last minute. It means smaller banks are going to have to pay higher returns on deposits, and that then means they're in, you know, they haven't got a critical advantage.
Right. How are you thinking about how that translates to the wider economic environment? Mike Wilson over at Morgan Stanley thinks that there could be a credit event. The latest Bank of America fund manager survey also says that a systematic credit event is now the highest risk over inflation. To you, what is the biggest risk?
So I think there's a causal link in there. So we still have very significant inflation. The UK just showed it's not going down monotonically.
Still double digits?
It's still double digits. That is scary. You know, the US still has an inflation problem, and particularly when you look at wage inflation in the services industry, you know, while that is 6, 7, 8%, you're not going to get back down to 2% inflation. The Fed, you know, I mean, it was really sort of easy to forget Powell's presentation to the Senate 2 weeks ago. You know, with everything, what he was saying is we have to push harder, and effectively we have to break something, right, in order to get inflation down in the US. I'm afraid that if they want to get it back to 2%, they have to have more people looking for work than there are jobs available. You know, at the moment that ratio is the other way around. When you've got that, then yes, you've got the sort of negotiating power is in the employees, and so you get wage inflation. If you want to get inflation, anyway, so they sort of have to break some stuff. I mean, this bit when people say, yeah, we're going to get rid of inflation without breaking anything, we're not going to increase unemployment, we're not going to, like, something's going to break.
Right.
And, you know, we're seeing part of it is in the banking system where people got into the wrong position. It will, so I think it's a sort of, you start with, if you want to get rid of inflation, then they have to keep rates high enough to cause pain, and that will break things. Something at the boundary will break, and then you have to deal with it.
What do you make of the argument that, and you alluded to this, something has broken, now the Fed can stop, other central banks can stop?
In a difficult way of saying it, not enough has broken. Look, I mean, Credit Suisse is big news because it's a brand name that we all know throughout our career type of thing. Even, you know, but the reality is Credit Suisse has been, I don't know, I'm not sure whether shooting itself in the foot is a polite expression anymore, but, you know, they've been sort of working their way up both legs with a gun for the last 5 or 6 years. You know, I mean, it's a constant thing. And so it was inevitable that, you know, Credit Suisse wasn't going to survive. And it happened that, you know, it's this last squeeze is what did it, with a sort of demonstration of a sort of run on deposits. But, yeah, that one is relatively unique. While the problems are in smaller banks, whether it's regional, whether it's local, sort of, it isn't an existential risk to the system. You know, look, if we get to, you know, pick your favorite, but I mean, Bank of America is the one with the biggest unrealized losses in their hold to maturity box. You know, I mean, I don't think there's a problem there. I don't think there will be a problem there. But that's the, you know, if we end up there, then we know we're in a real crisis.
In terms of that, it has been a period we've seen over the last week of assets that are considered risk-free or close to risk-free have been the demise of SVB. AT1s in Switzerland, more risky than perhaps most people had thought, given that they've been zeroed out.
I got to say,
yes,
the one rule of investing in credit is you've got to read the document, right? And it said in the Credit Suisse AT1 documents, I mean, it said what would happen. The Swiss government wasn't pretending. The rules are different in Switzerland than they are in the UK, or they are in France, or they are in the US. The US banks don't use this stuff as much, but the one rule in credit investing, and this is, to that question that sort of might, will a systemic credit event cause the problem? I don't think we've seen the lows in equities for this cycle. Personally, I think we have a big sell-off somewhere in our near future. I mean, I don't mean this week, but I mean, coming. Could it be caused by credit? Will it be caused by earnings first? Don't know. I mean, you have to see how it develops. But people who, if you invest in a bond or you lend money to someone and you don't read the document, you deserve whatever happens to you.
But is it not a symptom of the zero rate environment, that people were taking more risks and paying less attention to them? Are there more shoes to drop?
Yeah, I mean, look, yes, people got used to for 10 years, there was effectively no credit risk in the world because it's quite hard to go bust as a company when you can borrow money at zero forever, right? I mean, it's like you have to work really quite hard to make a mess of that because money was free. There was no reason to have a diversified portfolio. This is about strategies for wealth creation. For 10 years, diversification was stupid, right? You wanted the most concentrated portfolio you can have. There was no point in risk management. If it went down, you just bought more. And that was the right strategy for the 2010s, all the way up until, we got to 2022. But once inflation is out and in the system, as it now is, I would say it's exactly the wrong strategy. And so in a pivoting from, there's a lot of people still sticking with, I just buy every dip in equities and hopefully it'll work out. But I don't think it will for the next 5-10 years while we have an inflationary period. Diversification really helps in that type of thing. Risk management really helps. And, I think you want a completely different portfolio. Obviously you did in 2022, but I would say you do for the next, I would guess this is the rest of the decade type of thing.
Have you seen that change in what's in demand at Man Group too?
So our client base is institutional.
Okay, Danny Berger in conversation with Man Group CEO Luke Ellis there. You can continue to watch this event at Live Go. I'm Tom McKenzie in London with Kriti Gupta in New York. Anna Edwards and Matt Miller are off today. And Kriti, as we listen into that conversation about the risks in the financial sector, that ties us to the look ahead to the decision from Jay Powell and the Fed.
It really does. And look, you heard it from Luke Ellis there. You got to read the document when it comes to the bond market.
Yeah.
It's just probably in the same way you have to read every single word that the Federal Reserve Chair Jerome Powell is going to say today, which brings us, of course, to the spotlight event of today. It's Fed Day, and you are seeing a little bit of caution baked into the markets ahead of Fed Day. And simply what we're going to see at 2 p.m. New York time. Take a look at futures here, only down by 0.1%. No real conviction, no real momentum in either direction. But take a look at bond yields. That's really where I think all the action is. Yields actually lower on the day. How is that possible if the market is pricing in a 25 basis point hike today? At least a 75% chance. Remember, a pause option is still on the table. And then, of course, you have your outliers. A 25 basis point cut from Nomura, a perhaps even larger cut or hike from other firms as well. We're looking at a 2-year yield of 4.12. Really keep in mind whether how much of this is really technicals versus dislocations in the market. We're going to get to that throughout the rest of the show. The 10-year yield, 3.58. But, Tom, I think once we get through this little kind of period of Fed focus and banking turmoil, it's going to be all about the commodities market because we are looking at NYMEX crude with a 69 handle down about 0.4%. I also want to quickly
hit the commodities market.
Sorry, go ahead.
Carry on, Kriti. I jumped in too early.
No, that's all my fault. I'm just so excited about these pre-market movers. This is really important. I got to talk about Nike here. This is the one. Although I'm told that it's pronounced Nike across the Atlantic. That's a conversation for another time. Nevertheless, down 1.4%. Look, their sales came out pretty good, but their profitability missed. This is a market that is punishing you if those margins are too slim. And that's exactly what you're seeing here in Nike. Although, put this into perspective with some of the other hits we've seen, 1.4% is not that that much relative to the volatility we see in these markets. Nevertheless, green on the screen when it comes to some other volatile names. First Republic, for example, higher by just shy of 4%. Again, in the volatility context that we've seen, 20, 30% moves in one day. 4% is nothing. First Republic perhaps getting a little bit more assurance that they are going to be seeing a deal in their near future. GameStop as well actually came out. Tom, get this. First profit in 2 years. Those shares rallying by 43%. You've got your volatility dose there, Tom.
Wow, yeah, I saw a line in the story about GameStop. The fact that they're selling these collectibles has been key to driving and getting into profit for the first time, as you say, in 2 years. Look, it's the banks doing the heavy lifting again across European equities. That relief is continuing to percolate through the banking stocks. Whether that maintains and continues, of course, is going to be crucial. Ties us as well, again, to the Federal Reserve decision. But so far, that index, that sector gaining 1.5%. And on the context, building on the gains of almost 5% for that sector yesterday. So banks at the top, you've got the likes of real estate near the bottom when it comes to the sector-by-sector picture here in Europe. That's the benchmark, gaining 0.2%. The story in the UK is one that inflation is very far from ebbing. A surprise increase, 10.4% year-on-year, coming in well above the estimates of 9.9%. And that's leading to a readjustment in terms of the views around the Bank of England. They, of course, make their decision tomorrow. A 16 basis point move higher in terms of yields at the front end, 3.44 now for your 2-year. The pound is bid, gaining 0.6%, trading at 122, closing in on 123. Critty.
Yeah, let's bring it back to the macro, the economics here. We want to bring in Anna Stupnytska, global macroeconomist over at Fidelity International. Anna, a pleasure to have you on the show. Look, a lot of different moving parts here for the Federal Reserve, really kind of stuck between a rock and a hard place. To what extent has the ECB set the tone for the Federal Reserve?
I think they have set the tone, and we do lean towards a 25 basis point hike today, because it will be, again, just like in the case of the ECB, an important signal that the central bankers have the confidence in their tools to manage financial stability, and they will try to attempt this tool separation. So I think we will have a similar move from the Fed today, and then a more cautious approach going forward, meeting by meeting. But also crucially, we think that the terminal rate in the dots is probably going to remain the same. It's not going to be revised up, and that's again going to be a hike, but with a more dovish signal for the path ahead.
Well, Anna, if we do indeed see a pause, which I believe a minority on Wall Street are actually looking for, but still some major names, JP Morgan, for example, Goldman Sachs, saying that we might indeed get a pause from the Federal Reserve today. Is that cause for panic, or is that cause for repricing, given that the next meeting perhaps won't see that?
Yeah, I think, well, perhaps both really, because it really depends on how Powell communicates this. I suspect they will try to say we are just in the wait-and-see mode, we want to reassess, but obviously given the hot labor market, given inflation, given the strong economy, they will have to continue hiking. And if anything, that hiking timeline might actually be moved to the next meeting. I think it's going to be even a more difficult decision, a more difficult communication for them to send the right message to markets.
The assessment from some in the markets is that the banking crisis and the changes in loan conditions is going to and has led to a tightening, of course, of financial conditions. Some putting it at close to kind of 1.5% equivalent in terms of rate hikes. Does that suggest, Anna, that a lot of the heavy lifting has been done for the Fed? And how do you start to think around positioning for this?
Yeah, we do think actually that there is a lot of tightening in the system. And in fact, when we look at credit conditions in the bank lending channel, we know they have already tightened significantly. And what has happened so far will lead to slower credit growth, if not contraction, a few months down the line. So already a lot of tightening is there. The market stress is doing some work for the Fed. So I do agree it maps to some number of hikes already. And so that means that we should be thinking of positioning for the end of the tightening cycle. We remain very cautious, but we think the end of the tightening cycle is close.
Anna, does that take you into tech stocks? The Nasdaq is up, what, 15, 16% year to date? That's been something of a go-to for investors as they start to price in maybe a pause, maybe a cut.
For the time being, just from a multi-asset perspective, we are cautious, we are risk-off. and we are looking for opportunities, obviously, to re-engage, but we think we're not out of the woods, and so for the time being, we don't take much risk.
Anna, how are you thinking about QE versus QT? One of the calls that's really caught my eye here is Nomura's 25 basis point cut call, in addition to an end of quantitative tightening. If you look at the balance sheet, just from the Federal Reserve's perspective, after they insured those deposits from First Republic, Signature Bank, and the like, the balance sheet has spiked up about $300 billion. Should we be viewing that as quantitative easing to some extent?
Yeah, there's been a lot of discussion on this in the market, and I think it is clear that the expansion in the balance sheet we've seen so far is not equal to QE. It's not equal to QE because it will not lead to credit creation. This is a different mechanism, and so it's unlikely to lead to relaxing the banking standards and more credit. So it's more about liquidity. It's more about that protecting those transmission channels, especially for regional banks. And I do think that the Fed, as they start communicating a more cautious approach and potentially signaling the end of the hiking cycle, they will have to make a decision on QT as well.
OK, I want to get your views on the Bank of England. That event, of course, coming up tomorrow. And the red-hot inflation print, 10.4%, taking many by surprise. You're seeing that reflected in the pound and in gilts. How much of a challenge does it face? Or does it actually lead to clarity for the BO? It's pretty simple. They've got to go 25 basis points. They've got to hold.
Yeah, still I think it's a very difficult decision, and they have obviously laid some ground for coming to the end of the cycle, some ground for being dovish. And I think up until this inflation print, going for a pause would have made more sense. Now it's more difficult, and I do think they'll probably have to hike again, following that the ECB, the Fed template. But I think we can be pretty confident this is going to be last hike for the BOE in this cycle. The backdrop is weaker. The recession is coming earlier in the UK. We have seen some easing in some pay measures. So the labour market is potentially easing a little bit. And so I think they will have to pause after this hike.
OK, Anna Stupnytska of Fidelity International, looking ahead to the Fed later today, of course, and then the BOE tomorrow. Thank you. Still happening right now, Danny Berger in conversation with Man Group CEO Luke Ellis at the Bloomberg Invest Summit in London. You can continue to watch this conversation and more from this event at Live Go. This is Bloomberg.
Banking, I mean, there are how many thousand regional banks there are in the US. To have one that's suddenly doing a profile that's completely different than the others, it's more likely to be a problem than it is that they've invented some completely new.
This is Bloomberg Surveillance Early Edition. You're looking at a live shot of the principal room. Coming up later today, an interview with Morgan Stanley chief U.S. economist Ellen Zentner. That's at 1 p.m. New York time, 5 p.m. London. This is Bloomberg.
The euro area has been hit by an inflation shock, which is now working its way through the economy. While headline inflation is likely to decline steeply this year, driven by falling energy prices and easing supply bottlenecks, underlying inflation dynamics remain strong. And in such an environment, our ultimate goal is clear. We must and we will bring down inflation to our medium-term target in a timely manner.
ECB President Christine Lagarde there speaking earlier in Frankfurt. Of course, it's a big day for central banks around the world. From the comments to Lagarde to, of course, Fed Chair Jerome Powell speaking today. Joining us now for the key takeaways from that speech, Bloomberg's Maria Tadeo in Frankfurt, and, of course, a preview of that Fed Day commentary today as well. Michael McKee in Washington. Mike, I want to start with you there. We're starting to see a very kind of hawkish tone from the ECB, one that I think surprised a lot of the market that they stuck to that 50 basis points. To what extent have they set the tone for the Federal Reserve?
I think they're similar but different. There isn't as much of a banking crisis going on at the moment in Europe, so it's a little bit easier for Christine Lagarde to say that. Of course, the two banks that merged were Swiss, not even in the Eurozone. And the U.S. is still dealing with a lot of small banks, which you really don't have as much of that kind of construction in Europe, that are troubled. And so the question is, if the Fed raises rates, does that put them into more trouble? I think Jay Powell will and his colleagues will decide that it won't, at least not that bad. Things seem to be getting better. And they do need to send the message that inflation remains job one, the same way that Madame Lagarde did this morning.
Maria, let's bring you in at this point then. It was hawkish. It did sound hawkish from Madame Lagarde, and the thrust seemed to be, look, we have this 2% target, we're going to get there. There was a nod, of course, to financial stability, but it was all about inflation.
Absolutely. And look, one of the key takeaways for me, and we have now heard from the head of the European Central Bank 3 times in a week, and the message has been the same consistently. When you look at Thursday, that was decision day, they went in for 50 basis points. She said no trade-off between price stability and financial stability. Then you have the Credit Suisse deal on the Sunday. She comes in on the Monday morning, again repeating there is absolutely no trade-off. Today, she hammers down for the 3rd time that same message. This is a single mandate central bank that has to bring down inflation to target closer to 2%. This is the entire credibility of the European Central Bank in repeating this message that it won't be derailed from that. So to me, that is the first takeaway. The second takeaway is that, of course, there had been a lot of chit-chat about the forward guidance. Remember, for a while, we had very explicit forward guidance where it was almost very easy to calibrate the size of the hike going into a meeting. And the question was always, what happens in the next meeting? I think to some extent, we now have to make a difference between forward guidance and very explicit forward guidance. That very explicit, where you can measure in basis points already what happens down the line, that has been muted. But nonetheless, when you look at the forward guidance, that message today coming in general terms over the sense of direction was still clear. There is room to cover. They now have a 3-point criteria. You look at the data, you look at core inflation, you look at the strength of the transmission, and therefore you act accordingly. But the path is still one in which the European Central Bank is clear. They need to take action to bring down inflation.
So, Maria, before you started covering the ECB and geopolitics for Bloomberg TV, you were a credit reporter. Put on your credit hat for a second and talk to us about the volatility you're seeing in the bond markets around the world. How is that factoring into the ECB right now?
Well, a credit reporter, government reporter, I did many things before I joined TV, but it's a little bit of a blur, I might say now, just how life moves fast when you do TV. But overall, I think when you look at credit, the big story here, obviously, is the wipeout of the AT1s that happened on the Credit Suisse deal and the repercussions that could have then on the European translation for it. And on that front, the European Central Bank has also been clear, very elegantly, but though a subtle dig at times too at the Swiss regulators in the Swiss government and maybe even UBS, that they do not set the precedent for European legislation, that there is a very clear statutory order in terms of who takes the losses and who should absorb the losses. And that is a reassuring message, or a message that they hope will be reassuring for European banks. And what happened in Switzerland, this is a case that relates only to Switzerland. The European jurisdiction is run separately, and it has nothing to do with that.
Yeah, so far that reassurance, at least across the bond equity market, seems to be working, at least to some degree. Mike, let's bring you in then on that point. Maria saying that, look, they've essentially dropped the forward guidance at the ECB. What kind of guidance are we expecting from Jay Powell? Is there going to be a revision around the dot plots?
There's probably going to be a revision around the dot plots, but there's great confusion about what the dot plots are. There are 18 now, normally 19, but Lael Brainerd is off right now. 18 members of the Open Market Committee. Each one submits their own forecast for inflation, unemployment, and growth, and they also suggest what they think the appropriate monetary policy setting is to get to those forecasts. So you have 18 different ones that are then melded together, and we pick one in the middle, call it the consensus, and the market decides, well, that's what the Fed's guidance is. It's not really. The Fed's guidance is 18 different people with 18 different views. That's the hard part for the market to get. So, yes, we'll probably see a change today, but does it mean anything in the long run? I would think not. The Fed is going to be very, very data dependent, more than usual, because they're watching what's going on with the banks. But they're also close to the end of their tightening cycle, even if they think they need to do more. And so they don't want to go too far and send the economy into recession. So you might see a tick up in December. The last time they made a forecast, they said they'd get to about 5.1% on an effective basis. This time we might go up another 25 basis points to 5.35 or something like that. I think we won't go much beyond that. And the hard part for the market to understand is what this really means for Fed policy going forward. Not a lot of guidance.
Not a lot of guidance from the Fed or the ECB. Mike, thank you, as ever. Michael McKee, of course, in Washington, Maria Tadeo in Frankfurt. Stay with Bloomberg for our coverage, of course, of the Fed decision and news conference. Coverage starts at 1:30 p.m. New York time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. Now, a look at what's ahead today. Throughout this morning, of course, we will continue to hear from a number of ECB speakers from the ECB and its Watchers Conference. That's happening in Frankfurt. EU leaders are also meeting in Brussels. On the agenda is Ukraine, energy and competitiveness, with the US Inflation Reduction Act in focus. At 7 a.m. Eastern Time, UK Prime Minister Rishi Sunak answers questions from opposition leader Starmer in the House of Commons. That's after hotter than expected inflation data this morning. And of course, it is Fed Day. We get that early, eagerly anticipated decision. That's at 2 p.m. Eastern Time. That is it for Early Edition. Markets here in Europe are up, equities gaining. Surveillance is up next. This is Bloomberg.